Happy day. I'm going to handle the basic concepts under the Income Tax Act of 1961. Let's see some basic concepts. So let me start off with the assessment year, which is a very important concept in the income tax. So assessment year is defined under section 2, subsection 9, which says that the year begins from the 1st of April and ends on 31st March. For instance, 22-23 year assessment year begins from 1st of April 2022 and ends on 31st March 2023. The year preceding the assessment year is considered as the previous year, and the previous year is again consisting of 12 months starting from 1st of April 2021 and ending on 31st March 2022. Let's see the previous year for a newly set up business. If a business is set up in between the previous year, say for instance, it's set up in the month of August, so the previous year will begin from August and ends on March, and it will not be consisting of 12 months, that is from April to March. So the subsequent year for the newly set up business will consist of 12 months, which is again starting from 1st of April and ends on 31st March. Now, what is the uniform previous year? Uniform previous year for all kinds of persons will consist of 12 months, which starts from 1st of April and ends on 31st March. Now, there is a rule that says that previous year's income is taxable in the assessment year. There are certain exceptions to it, which says that previous year's income is still taxable only in the previous year and not in the assessment year. Let's see the various instances which says that previous year's income is taxable in the same year. First one, income of any non-resident from a shipping business. A person is said to be a non-resident if he fails to satisfy certain basic conditions. In that particular case, his income will be taxable in the same year and not in the assessment year, unless he has a representative assessee in India who takes care of his income tax proceedings. The second point says that if a person leaves India permanently or for a long period of time, in that particular case also, previous year's income will be taxable in the same year. Income of bodies formed for short duration. Certain joint ventures are created or formed for a limited period of time. So those sources will have to pay tax in the same year and not in the assessment year. Income of persons trying to alienate his assets in order to avoid or evade payment of tax. So in case a particular person sells his assets mainly to cheat or evade tax, in that particular case, his income will be assessed in the same year and not in the assessment year. Income from a discontinued business, in that particular case also, that particular individual will have to pay tax in the same year and not in the assessment year. Now let's move on to the next concept, which is person explained under section 2, subsection 31, which says an individual, Hindu undivided family, a company, a firm, local authority, association of persons, and artificial juridical person are all considered as person under Income Tax Act. When I say local authority, it means a municipality or panchayat. When I mean artificial juridical persons, is any kind of a corporation which is formed under a special act. These category of people are considered as person under section 2, subsection 31. Let's see the next concept, which is called as an assessee, which is explained under section 2, subsection 7. Assessee is any kind of a person by whom income tax or any other sum of money is payable under the Act. There are 3 classifications of assessees. Let's see one by one. The first one being the ordinary assessee. Ordinary assessee is a person under whom the proceedings of income tax are going on, or if a person files a return of loss, or if a person has to pay any amount and entitled to any refunds under the Income Tax Act. So in this category, we call that particular assessee as an ordinary assessee. The second category is called as a representative assessee. A representative assessee is not only liable for his own income, but he is liable for another person's income. The instances of a representative assessee are deceased person. If in case a particular person dies, in that particular case, the legal heir becomes the representative assessee. In case a particular person is a lunatic or a minor, you can have a representative assessee. And the third one, in case of a non-resident, there can be a representative assessee appointed on his behalf. The third category of assessee is the assessee in default. Assessee in default is a person, if he does not satisfy the statutory obligations under the Income Tax Act, we call him as an assessee in default. These are the three major classifications of assessee. One is the ordinary assessee, representative assessee, and assessee in default. Now let's see a very important concept under income tax, which says income. Okay, income is defined under section 2, subsection 24, which says that it is a periodical monetary return with some sort of regularity. And income is nothing but it increases the value or it increases the wealth of a particular person. Now, how to charge tax on income? Now, income tax is calculated or assessed once in a year, and therefore we call it as annual tax. So, number one, annual tax. Then, coming to tax rates, what rates are applicable when computing the tax of a particular person? Tax applicable for an assessment year is only applied for computing the tax on the income earned. Who fixes the rates? The rates are fixed by the Finance Act and not by the Income Tax Act. Tax is levied on every person, irrespective of whether they are individual, HUF, firm, company, AOP, artificial juridical person, and local authority. Tax is levied on the total income. Now, when I say total income, how do we calculate total income? We need to calculate the gross total income and we need to claim deductions under section 80C to 80U. We get net income or the total income. The rates are applied on these total income and we need to compute the tax. Let's see the next important concept, which is called as a gross total income, which is explained under section 14. Now, gross total income comprises the aggregate income from all the different sources. We have basically 5 different sources. Number 1, income from salaries. Number 2, income from house property. Number 3, profits and gains of business or profession. Number 4, capital gains. And the residual head of income is the income from other sources. So when we aggregate all these different sources, we get what is called as gross total income. Now let's see what are the features or characteristics of income, which is very, very important. Number 1, income is a regular and a definite source. So we get income with, or we say income is a periodical monetary return with some sort of regularity or expected regularity. There are different forms of income. We say income can be in either cash or in kind. Now, an income can be received or it may accrue to an assessee. So, when it comes to tax consequence, we say income is taxed on either receipt basis or accrual basis, whichever falls earlier. Illegal income. The Income Tax Department or the Income Tax Act does not distinguish an income between a legal as well as an illegal income. Disputed title. The income tax assessment or the income tax proceedings will not be postponed just because there is a dispute in the title of the particular person. So whoever receives that particular income, in those hands that particular income will be taxed. Reimbursement of expenses are not treated as an income. I can give you an example. Say an employee is being deputed to go to another place in an auto. So he spends out of his own pocket and later on comes and reimburses from the employer. So this reimbursement is not treated as an income for the employee. Temporary and permanent income. Again, income tax does not differentiate an income as permanent and temporary. The tax consequence is the same for both permanent and temporary income. Income includes loss. So I can give you an example and I explain the concept. Say for example, an assessee has 5 different businesses and he gets income from 5 different businesses. Say he has business A, B, C, D and E. He gets income from business A, B, C, D and he gets a loss from business E. Now, when we find out the total income from business for that particular assessee, we need to add all the incomes and adjust this loss against the income what he gets from the 4 businesses. So this we say, and this particular income is included in what is called as gross total income for computing his annual tax. So therefore we say that income, that is a gross total income, it even includes the loss. The loss is adjusted against the income. Source of income need not exist in the assessment year. As I already told that the previous year's income is taxable only in the assessment year. but at the same time, the source need not exist in the assessment year. For instance, if an employee earns income from house property in the previous year 21-22, this particular income will be taxable only in the assessment year, but that house property need not be owned by him in the assessment year. Therefore, we say the source need not exist in the assessment year. PIN money is nothing but the pocket money what the assessee receives is not treated as an income and therefore it is not taxable. Income to be earned from outside. Now, I can give an example for this. If a person is running a business, he has to earn the income from outside, meaning to say for example, he is selling certain products. Now, he has to sell the product and get income from that. Then only we say that he has earned a real income and not the fictitious income. So therefore, we say income to be earned from outside. Income may be received in lump sum or otherwise. So again, Income Tax Department or the Act does not differentiate the tax consequence for an income which is earned in a lump sum manner or in an installment manner. In both cases, if an assessee receives that particular income during the previous year, it is subject to assessment. Same income cannot be taxed twice, meaning to say the particular source of income should be taxed only once and not twice. This point I've already referred before. I say that income should be real and it should not be fictitious, meaning to say it should be earned from outside. Then only we call that particular income as a real income. Award received by a sportsman by exercising his profession is fully taxable in the hands of the assessee. Prize on winning a motor rally is also treated as a source of income and therefore it is taxable. Now, if an assessee earns income by way of devaluation of currency, that is also treated as an income and subject to assessment. Receipt on account of dharmada is not treated as an income. In case a particular person receives as a donation or as a voluntary payment, it is not treated as an income. Surplus from mutual activity is not considered as an income. I can give you an example. Say 4 members are joined together to start a club. The subscription is received from the 4 members for the maintenance of the particular club. Now, the surplus, what is derived after adjusting the expenses, are returned back to the members of the particular club. That surplus, what the members receive, is not treated as a income and it's not taxable because that particular income is not earned from outside. If an employee receives a tax-free income, it means that tax is already deducted at the source and then only it is given to the employee. And therefore, when tax is being assessed, that particular tax-free income has to be grossed up for computing tax so that that income is not taxed twice. Diversion of income by overriding title versus application of income. If a particular person receives income and later on diverts that particular income to another person which does not belong to him, in that particular case, he is assessed only on the part of the income what he earns and not on the part of the income which is diverted to another person. So that's called as diversion of income by overriding title. Whereas application of income is nothing but applying the income whatever is earned is subject to taxation. For instance, I can give you an example. If particular person called X receives 9,000 as his income and spends 4,000 for an eligible deduction, in that particular case, that 4,000 what he spends is called as application of income. Appropriation of payment between capital and interest. Say for example, a creditor receives an open payment from the debtor. In that particular case, the particular income tax department has every right to adjust that particular payment against the principal amount and not the interest amount. Revenue receipt versus capital receipts. All revenue receipts are taxable unless and until it is expressly exempt, and all capital receipts are exempt unless and until it is expressly taxable. I can give you an example of a revenue receipt which is exempt, which is nothing but agricultural income in India. And the capital receipt which is taxable is nothing but the capital gain head of income which is taxable under section 45. All voluntary payments are subject to tax. The burden of proof lies in the hands of the assessee to claim more deductions and to pay lesser tax. Thank you.